How do EI, CPP, and income tax withholdings work for foreign employers? When a foreign employer hires people who live and work in Canada, it steps into a system built around three major components of payroll withholding: income tax, Canada pension plan contributions, and employment insurance premiums. These three deductions show up on every Canadian pay stub, and the employer is expected to handle both the employee's share and, where applicable, the employer's matching or contributing portion. For a US company, the structure will feel familiar, but the terminology, thresholds, and remittance rules are different. What matters most is understanding that the Canadian system expects you to behave like any other employer once you are paying Canadian employment income. Income tax withholding at source. Income tax withholding is the core of the Canadian payroll system. Employers estimate the employee's annual taxable income based on pay frequency and salary, apply the appropriate federal and provincial tax rates, and withhold an amount each pay period to send to the tax authority. Employees fill out standard forms to declare basic credits and, in some cases, additional amounts, which adjust the default withholding. As a foreign employer, you are not exempt from this mechanism. If your company pays an employee for work they perform in Canada, you are generally expected to register as an employer, calculate the proper income tax withholding on each pay, and remit that amount on the schedule assigned to your remitter category. Year-end, you issue a slip that summarizes total earnings and tax withheld so the employee can reconcile everything on their personal tax return. Canada Pension Plan contributions. Canada Pension Plan, or CPP, is a contributory pension program that covers most workers outside Quebec and provides retirement, disability, and survivor benefits. Employers and employees each contribute a percentage of pensionable earnings up to an annual maximum. On each pay, the employer calculates the CPP contribution, withholds the employee's share, and adds its own share, remitting the combined total for all employees with their payroll remittance. Foreign employers are expected to participate in CPP when their employees are covered by the plan. There are exceptions in situations where international social security agreements apply and the employee continues to contribute to the home country system instead of CPP, but those situations typically require a formal certificate of coverage. Without that certificate, the default is that Canadian work covered by employment law is also covered by CPP. Employment insurance premiums. Employment insurance, or EI, funds benefits for workers who lose their jobs under certain conditions and support specific types of leave. Like CPP, it is financed through contributions deducted from employees and larger premiums paid by employers. Each pay, the employer withholds the employee's EI premium and contributes its own portion, then remits both together. For a foreign employer, participating in EI is part of being recognized as an employer in Canada. If you are treating the worker as an employee and they are insurable under Canadian rules, you should assume EI applies unless there is a clear exemption. That participation also gives employees potential access to EI benefits if they meet the program's qualifying criteria. How these three pieces work together on a pay stub. From an employee's perspective, a proper Canadian pay stub shows gross pay, income tax withheld, CPP contributions, EI premiums, and the resulting net pay. For the foreign employer, those three deductions represent amounts that must be tracked and remitted regularly under the payroll account. The employer portion of CPP and EI is an additional cost of having Canadian employees, much like the employer share of Social Security and unemployment insurance in the United States. If a foreign employer runs Canadian payroll informally, withholding only income tax, or worse, nothing at all, it creates gaps not just for the tax authority, but for the employee's pension and benefit entitlements. Interaction with U.S. Social Security and international agreements. U.S. companies often ask how CPP and EI interact with U.S. Social Security and Medicare contributions. The answer depends on whether an international agreement applies and how long the assignment or arrangement is expected to last. In some cases, employees can remain covered by the U.S. system alone for a period and be exempt from CPP, which avoids double contributions. Achieving that usually requires obtaining a certificate of coverage from the U.S. authorities and ensuring Canadian rules recognize that exemption. If no such coordination is in place and the employee is genuinely working in Canada as an employee, the default is that CPP and EI apply. That means the employer should not assume that US contributions alone are enough. Employer registration and remittances. To handle income tax, CPP, and EI withholdings, a foreign employer registers for a payroll account and then follows the same remittance rules as any other employer. That involves sending combined employee and employer amounts on a set schedule and keeping records that tie each remittance back to specific payroll runs. As the total payroll grows and as the remittance history develops, the employer may be reclassified into more frequent remittance categories. Missing remittances or sending incorrect amounts can lead to interest and penalties, even if the employee's eventual personal tax return is correct. From a compliance perspective, the obligation is to withhold and remit correctly in real time, not to rely on the employee to settle everything at year-end. Final thoughts. For foreign employers, EI, CPP, and income tax withholdings in Canada work much like a three-part version of what you experience at home. Tax, pension, and unemployment-style insurance, all deducted at source and remitted by the employer. Once you are paying Canadian employment income, the default expectation is that you participate in all three unless a specific and properly documented exemption applies. If you are planning to hire in Canada or already have staff there but are not yet handling CPP, EI, and income tax withholdings, it is worth revisiting your approach before balances grow and penalties compound. For more straightforward guidance on cross-border payroll, you can explore resources at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.